So yeah, for those of you who don't know me, my name is Dmitry. I'm the portfolio manager, trader, analyst. But for you, basically, I'm the guy who has the answers. That's the only thing that matters, actually. So today we will be talking about the risk management tools that you guys need to use when trading, regardless of the market trend, whether it's a bullish trend or bearish trend. It's just that risk management is what defines the success, and it doesn't really matter how many times you were right. Like in a row, you can be 5 times in a win, but as a result of a bad trade which comes next, you can lose all the money you made on this first 5 winning trades in a row. So that's why risk management really matters, and what we need to understand is that the potential reward should always exceed the risk that you take per each trade. So that's something that I will show you, how to calculate this risk to reward ratio and what are the tools to be used in the automated trading that we have here at Bitsgap, so that you can not only maximize your returns but to secure your trades. So yeah, let's start. So that's what you see right now. That's my current situation over here. You see I have 4 bots active, and let's see, that's LTC, that's 0x. So actually I launched them a day ago, so that was exactly yesterday. Exactly then the market almost kicked our asses, but I hope it not for most of you. Hopefully you use the stop loss and other risk management tools that we will be talking about today. But you see, I launched these bots yesterday, and the way I launched them, let me show you real quick on some other cryptos. So for example, yesterday I looked at the chart, and I realized that's the buy opportunity. So what I did is actually I eliminated all of the sell orders. So I just wanted to have my grid with only limit buy orders. So as the market was around this area yesterday, I set my trading range like this. So I had like 40, or what is that? Let me see. 13, 16. Yeah, I had the most was 20 grids. This was the biggest number of grid levels that I set. So I thought that as the market was falling, and I looked at the chart of those cryptos that I believe to be prominent, I realized that by looking at the support and resistance of previous all-time highs, I realized that that's the perfect buy zone, and that's why having this kind of setup for the bot is the ultimate solution for the dollar cost averaging if you want to enter the market at the best entry price. Because the thing about bots is that by utilizing this algorithm of grid levels, you proportionately enter the market. So you're not just, I mean, in other cases you would just enter the market with one buy order. So that would be your entry price at a certain price level, and that's it. But with the Autobot, the thing is that you split the investment and you proportionately gradually enter the market. So that's the thing that I wanted to do, is that if it falls, at least it will capture all of my grid buy orders, so that my entry price, like weighted average entry price, is ultimately gonna be somewhere at the lowest possible level, so that eventually at the bounce off I will quickly regain and offset the risk and will start earning money. So that's actually what you see right now, exactly in my case for the Bitcoin, Quantum and 0x. So not only did I launch these bots, I actually bought some Bitcoins just from the smart trade mode over here. Let's see all the history. Okay, so these orders that you see are related to bot trading. That's not actually what I wanted to show you. Okay, in that case, let me show you my manual trades in another way. So let's go back to bots, and here I have the balance. So you can see that not only I have Bitcoin here in active trade, and if you look at it, if you open details, that you see that's the exact amount that I currently have in this trade. So that's my current risk exposure in this particular trade. But apart from that, I also have Bitcoins on my balance here. So that's when I entered the market as well manually. So I mean, I tend to diversify with the smart trading mode and automation. Automation is the ultimate solution for you guys to enter the market gradually. And that's the lowest risk and the easiest option for you guys to trade. That's the automated trading with the S-bot or the classic bot. Whereas when it comes to the manual trading, there are some tools that we have at Bitsgap that can help you to enter the market and to exit the market when necessary, with some tools that we have here. So, for example, you can enter with this smart limit buy order. So for example, let's say I want to buy Litecoin right now at the current price of 2004. And let's say I want to spend 10%. No, actually, let's see. Okay, 75%. And let's say I want to set my take profit maybe to this point where I have the price of 270. So I'm gonna do like this, 270. Notice that the system automatically calculates the exact percentage up to that point, and that exactly corresponds to the return that you get, and that's 31%. And also, it's not necessarily that you have just one take profit. You can split it by 5 orders, and this is even better. Because by having multiple take profits, you actually secure your unrealized return. Because the more take profit orders you have, the higher are the chances that with each increment, I mean with each price fraction growth, you actually get some returns. So let's assume that these blue lines that you see on the chart, that these are my take profits. So if the price hopefully moves in the upside direction, then it will gradually, you see, it will execute one by one. So that means that by executing each order one by one, each take profit one by one, you reduce your market exposure, as basically it's gonna sell the Litecoin at that price level. And by selling Litecoin at that each price level, it's gonna realize the return, which will go directly to your pocket, right? That's the only thing that matters in trading, because we have two things. That's the unrealized return, which is something that is pending, and it can be that one day you are up by $500, but the next day you wake up and you look at this trade, it is now minus $100. Because you did not fix the return that was yesterday 500. Now it's minus 100 unrealized return. So that's why the only thing that really matters, what defines your success, is actually the realized return. And the best way to secure your returns is by having multiple take profits. So, and that's why we have developed this option for you guys to split the risk. And let me just demonstrate real quick on Litecoin. So, okay, we have this target, but maybe let's have it at 5%. Then the next gonna be somewhere around 10%. The next is gonna be, let's say, 20%. And the next at, well, make it 30%. And also you can decide the amount in percentage that you are willing to sell at each of these take profit order. So for example, if you are impatient and you are really worried and you are not that confident that the price will recover quickly, then maybe you need to allocate more in your first two orders. So that's going to be 30-30, and that's exactly 60%. By the time, I mean, you will get rid of the 60% of your market exposure by the time it reaches 10% upwards. Whereas the rest 40% are split by the rest take profit orders. The one which is higher by 20%, and that's the exact price at which it's going to execute it. And the next one, the highest one, is at 30% of growth price target area. So that's the thing, how you can split. So the more you are impatient and the more you are worried and the less confident you are, just allocate more in your first two orders or three orders, or at least decrease the gap, because you see the gap here is 5%, whereas compared with what we have higher, here we have 10% gap. So you can play with the gap. If you are worried, then let's say you can have 5% here and 8% here as well. Well, it will not bring you big returns, but still, that's something you can play with. The ultimate thing to look at is the projected profit. This is the return that you can get if all take profits are triggered by the market. So if all targets are met, then that's the exact profit that you get. Make sure that your risk is not bigger than the risk, the potential return that you can have, right? So for example, from the entry price, let's say you want to put your stop loss below by 5%. If like under some unfortunate circumstances, if the price drops further down and it triggers your stop loss, which is below the current, which is below the entry price by 5%, this is the loss that you will get. That's $2. But this loss compared with the projected return is by 3 times lower. So this is a justified trade setup where you have your projected profit by 3 times larger than the projected loss that you take. So that's something to play with. Always make sure that the stop loss is justified. And if it's not, for example, in this trade, I would enter it only if I had my stop loss below this area. So that's exactly 138. Let's see if this is justified in that case. Why is that? Why is that? Tell me, please. Are you stupid? Trigger price 138. What's wrong with it? That's strange. That's really strange. It shouldn't be like that. Okay, let's put minus 30% maybe. Yeah, well, it's pretty much minus 30%. So you see, if I would plan to enter the market with this, with what I see on the chart right now, I would set my stop loss here. And in that case, that's the 30% down. And that's the risk that I take here. So either I need to make changes in my take profits, but by doing that I need to actually boost my confidence that it will go even higher, so that the return that I will eventually generate exceeds the risk that I take. So it doesn't look like that in accordance with this trading setup. So I would rather skip this trade opportunity, just because the stop loss, I mean, I put my stop loss based on the support and resistance lines that I see, and I always set trade based on these key price levels. It's not that I trade based on the price percentage that I'm willing to take as a risk. I just look at the chart, I set the stop loss on the chart, and then I calculate the distance to that stop loss. If that's too much and the profit potential that I can take from this trade is lower than the potential risk, then it just makes no sense for me to enter the market with this trading setup. Okay, but the thing is that to reduce the risk, I can enter with the bot in that case, because the bot would split the risk So not only I would set my stop loss over here below, but the fact that I have multiple buy orders, that means that my investment is proportionately distributed. So if like the price falls and it triggers all of my buy orders, eventually my weighted average entry price is gonna be somewhere around this area. Okay, and now let's estimate in that case the price range from this average entry price and the stop loss. So that's exactly 17%. So you see, in the smart trade mode it was around 30%, but thanks to the bot with its dollar cost averaging effect, it gives me a better entry price, and that means that I'm now closer to my stop loss, and that means my risk is reduced by half, in that case almost. It's 17% of a risk instead of 30 that I had. So that's the point for you guys to consider. And then that's an obvious example why automation is less risky and is at some point, in some cases, even better than the smart trade. The only thing about the automated trading is that you do not have a control over the return that it will bring you. Whereas in smart trading, you can always change the take profit price and all that stuff so that you can either increase your expectations or decrease your expectations depending on the market volatility and what you see the chart showing you. So in smart trade mode, and by smart trade mode I named this trading that we have in trading section. It's smart because you can control the risk by take profit manually, you can control it by the stop loss. So that's why it's smart. There are many ways for you to exit and enter the market, that's why it's smart. But since it is a smart trading, it really requires you to keep a sharp eye on the market like almost every day, so that you make adjustments then necessary. Okay, so for example, if the price moves like this, then eventually I would drag my stop loss around this area, so I would put it below this support line in that case. So as the price moves, I need to make some adjustments, which is also, by the way, the case for the automated trading, where you have bots with this stop loss. As of now, I actually don't have the stop loss on any of my trades. It's just that I'm completely indifferent right now towards the performance of my bot. It's just that I use them in order to buy the crypto. So I thought that even if it falls heavily, at least it will buy the crypto at achieving the dollar cost averaging effect, which is good. That is something that I wanted to see in case if it falls, because in a long-term perspective, I believe in the market growth, and I don't see any reasonable reasons to assume that the heavy downfall will continue. I mean, it's not a financial advice, of course. It's just that my observations and taking into account why the market fell and what were the reasons why it fell. It's just that it's too stupid to capitulate for me, to be honest. So, I mean, what I'm trying to explain to you guys right now is what kind of logic you can use when trading automated bots. The way I applied logic yesterday is that I just wanted my bots to achieve the dollar cost averaging effect in case if the price falls in this corridor, like down to this price level. But it did not actually happen, and it looks like my bots are now in profit. You see, they are already trading for me. So, but the thing is that you see I have only few sell orders here. That means that my real market exposure here is around 20% or something. If you look at here, you see only 5 quantums is my current risk exposure in this trade, whereas the rest is in the stable coin, right? That's why I manually bought some Quantum, Ethereum, and other coins to have a risk exposure on this bounce off. So that's the thing. I diversified trading by automated bots and manual trade and smart trade mode in this section. So that's the thing. So another logic would be, let's say you want to enter the market right now. Let's open any random coin. Let's go look at Algo, BUSD, wherever. Look at it. And so the way I would do it, maybe I would look at the lowest price we had yesterday, which is over here. So I would put my lower price exactly here, and the upper price, well, I would put it maybe somewhere around this area. That's the next key resistance point. So in that case, if you look at this setup, and it's pretty obvious that your green zone is wider, whereas your sell side zone is narrow. That means that it's pretty much a 40% split by 60% split. So that means that if you enter this configuration, that it means you will be from that point, like from that price that we have right now, which is 1.04, you would be in the market by exactly 40%. Okay. The way to look at it is that your sell side always defines your initial market risk exposure. And that's exactly what is displayed here. If you enter the trade with this configuration, you would need to have already 33 algos in your possession. Why you need algos of that amount? Simply because you need it to set all of these limit sell orders. Otherwise, it's impossible to sell something if you don't have it on your balance, right? So that's why, that's the thing for you to keep in mind always, that even without these specifications, it's just visually that you can see that it's going to be around 40% of the initial market risk exposure out of your $100 that I have here. So if 40 out of 100, that's exactly $40. So that means by $40 is going to be your exact market risk exposure as you enter the market. The rest 60% you will accumulate if the price falls. Okay, so that's the trading setup that you might consider if you feel like the market is now recovering back after this short sell-off that we had yesterday. Yeah, and if you feel like there is still a risk that it might fall, right, then first thing you could do is to minimize the investment you allocate in this trade. That's the first thing, to minimize the risk. The next risk minimization tool would be to set the stop loss, and I would set the stop loss below this lowest price that we had, right? But some traders are not actually taking into account the shadow of candles, but rather they are looking at the body of the candle. So that means that you would not consider this as a support, but rather you would consider this as the local support. So that's why you would set your lower price around this area, and you would set your stop loss over here. Okay, so that's the thing, and to reduce your risk exposure as well if you are trading based on the bodies of the candles on the chart. So yeah, the SBOT is the ultimate strategy to enter the market if you feel like it will move sideways for some time. Let's just remove some drawings. Sideways for some time, or if you feel like it might fall a bit before it recovers. So the as bot is your ultimate bot to grab, because it would bring you the most returns compared with the classic bot, and yeah, that's the only one to compare, the classic bot. The reason for that is that how it distributes your investment. So the as bot, and notice that all active trades that I have are in the as bot mode. That's because if you look at all orders that I have, is that it buys more coins. Where is that? Yeah, you see, it buys more coins as the price is cheaper. So you see, for the price of 135, it would buy me this amount of, what is that, Litecoins, right? If the price is higher, then it would in that case buy me fewer coins. The reason for that is that per each price level it spends an equal investment value. So if you multiply the price by the amount in this trade, or for example this one you multiply by its amount, you will get the same investment value as in this case, or in that case, or in that case. So the as bot, per each grid level, it spends the equal investment value. Whereas in case of the classic bot, let's switch back to the demo mode real quick, just for me to show you guys the classic bot. Blah blah blah. Let's set it 0.1. Let's assume that I want to buy. Okay, let's go. Yes. Okay, come on. Show me the magic. Yes, my folks are waiting for me. So yeah, here we go. You see the classic bot, order statuses. You see, in case of the classic bot, the amount is the same. That means that regardless of the price, whether the price is cheaper or more expensive, it always buys the same amount of crypto, which is a bad thing on the falling market, because it would not spend my investment in a wise way. But the classic bot is the best bot for you guys to trade if you feel like strongly that it will rally, the price will rally. Then the classic bot would bring you the biggest return, because as the price appreciates, and we know that the classic bot always buys the same amount of crypto per each level, that means that it will increase your investment allocation as the price appreciates. So for example, as we know, it buys the same amount of crypto, let's say 10 coins per each level. At some point you will see that 10 coins cost you $100. But at some point, as the price appreciates, these 10 coins would cost you now $150. So you see, now you spend by $50 more. So that means, again, it basically shows you that as the price appreciates, the classic bot buys you, I mean, it increases your investment allocation just by following this algorithm. Whereas in case of the as bot, it's not like that. The as bot always spends a certain sum. So for example, let's say $100 is the amount it spends per each grid level, and at some point you will see that this $100 would be enough to buy 10 coins. As the price falls, with $100 now you can buy 13 coins. So as the price falls, you accumulate more coins. So eventually, as the price reverts, having more coins compared with the classic bot, your recovery will be faster and you will generate more returns compared with the classic bot, right? But if the price then rises significantly, then at some point you will see that it underperforms compared with the classic bot, because the price goes higher and the bot keeps spending $100 per each level. So that means that as the price appreciates, it now can afford fewer coins. At some point 9 coins, and let's assume the price is now at this area. So with $100 it now can buy only 7 coins. So you see, as the price rises, it now buys fewer coins. That means that your risk exposure is actually diminishing compared with the classic bot. So all things considered, once again, the S bot, guys, is when you feel the market is gonna move out either sideways like this, or if you feel like it's gonna fall a bit and then revert. So in that case, make sure that your trading range can cover this area, yeah, and use the S-bot in that case. It's gonna be a quick recovery, it's gonna be a quick bounce off, and the S-bot is the ultimate bot to achieve the best dollar cost averaging effect. That's the thing. The thing about the classic bot is that you can also, of course, trade it on the falling and on the sideways and on the rising market, but it's just that from the performance perspective, it will bring you less returns compared with the S-bot on the sideways market and on the downfall. But on the rising market, the classic bot is your ultimate solution in any case. So if you feel like the price gonna move like this, then maybe it's for you to choose the classic bot. Make sure that you also enable the trading up, because once the price breaks the upper price, you want the bot to continue the trading, right? You want the bot to trade even in this area as well. That's why trading up is a must if you want the bot to automatically follow the rally. So by that, I mean that once the price hits the upper price and goes higher, and let's say that we are now trading in this area, you would see that your trading range would be exactly over here. So basically, as the price appreciates, your trading range is gonna follow. Boom, boom, boom. Let's say we are now trading in this area. Again, your trading range now would be here. So that's why it's known as the trading up, because it only follows the rally. If the price drops from that point of the pick that we made, and it breaks the lower price and goes like this, the trading range will not follow the downfall, it will stay here. And the best way for you to remember this tip is that it's up. So by that, you will always remember that your trading range only goes up, it never goes down. That's the thing that's how it works as it is as of today. I know there were some questions, and I think like one guy even made a video, and I saw this video from the support team. I got this video, the guy asking to implement the trading down feature, and that's something that of much debate for us. That's something that we always discuss, whether or not, and if yes, then how, what are the cons and what are the process of this trading down feature implementation. It's just that we decided not to do that now due to the risk management principles that we follow, and we want to secure your trading. But maybe it will be changed in the nearest future. Maybe we will add this feature, right? It's just that let the community speak, and we will take that into account. So that's something that, once again, we are discussing whether or not to include the trading down feature, right? Because yes, of course, there are some use cases for the trading down, but from the risk perspective, it's just that it's gonna be riskier for you guys, especially for those who are not enough experienced and do not understand what's the difference with the change and the bot profit, for example. And that's my actually aim to teach you how to read this metrics, how to trade using all the tools that we have before we actually implement further improvements, like for example the trading down, because trading down is really riskier and it requires you to have some knowledge about the market, and that's my aim. As soon as we feel like we are ready to implement the trading down, maybe we will implement it. So I hope I answered your question with regards to the trading down. So let's move on. I see some of you asking what coins to buy and sell and how to react to the falling market. Well, the thing is that it's up to you to decide which coins you really want to have in your portfolio, and in which coins you want to have the most exposure. It's all about the confidence, right? And this confidence in certain coins is defined by the knowledge that you have on these coins, and what is your retro perspective, and what are the tools that you are using when evaluating the risk, what are the fundamental and technical analysis skills that you have, and what is your basically trading strategies that you use. So for example, in my case, I set my stop losses always below or above key historic price levels. That's it. Some do that in other way. And that's why there is no golden rule for you to follow in order to beat the market all the time, right? It's basically impossible to be 100% accurate, right? That's why the key to success is, the first rule is risk management. And risk management is actually, let me actually use this one text. Let's make it 40. Yes. So the first rule is risk management. And the risk management is defined by the asset allocation. So that's basically the amount that you can afford to allocate per each coin. So for example, that's $100. The next thing is the stop loss. So let's say your stop loss is in a range from 10 to 30% per each trade. So that means that you will lose from $10 to $30 based on the allocation that you have. So per each trade, you can expect to lose from $10 to $30. That's something that you really need to define for yourself, and that's something that you can, write it somewhere, print it, and put it in front of you, just to always follow the trading principles that you define for yourself, because that's really important, right? Always, the second rule is to have an optimal risk to return ratio. And in my case, that's the ratio that exceeds the value of 2. So for example, if your potential return is $100 and your risk is, let's say, 50, no, that's not actually, well, actually, yes. If it's, let's say, if it's $50, then if you calculate the ratio, let's call it Sharpe ratio. It's not actually the Sharpe ratio, but pretty much. And you divide the return, which is $100, by the risk, which is $50, and you get exactly 2. So that's the coefficient, that's the CAF, that I feel like the optimal one. So if you see that your return is by 2 times bigger than the risk that you take, then in that case, go for this trade. Okay? So the potential return in that case is defined by the take profits where you set them, and your take profits can be too far or too close. The larger is the gap, the bigger is the risk that the price will not reach this take profit. Okay, so that's why be realistic and set optimal expectations. Don't be too naive, and don't have exaggerated expectations. Look at previous key price levels. These are, in that case, resistance levels, And if you see that they are most likely achievable, right, then you can set the take profit close to that area. And in order to secure returns even more, set multiple take profits like I showed you before. For example, you can have from 1 to 5 orders in the mode that I demonstrated. Calculate the potential return per each order, and if this total take profit exceeds the risk that you take, then go for it, right? So these are the rules that I follow in most cases, right? And that's very important to follow the risk management. That's the only thing that defines the success. Apart from other things, of course, like the intuition that you get as you trade more and more and more, and as you learn about automated bots and you come up with better configurations that work for you, you become better at trading in general. And you will now know how to diversify your trading by having different strategies involved, right? Yeah, so that's why the fourth rule is to diversify. And by diversification, I mean not only having different coins. By the way, in crypto, it's really hard to achieve diversification by coins because they are so interrelated, and you can see that the correlation of like the vast majority of coins, like from top 50 cap coins, most most of them have a correlation from like 0.3 up to 1 and even larger. So that means that they are moving in tandem with the Bitcoin. So that means if Bitcoin falls, then these coins also will fall. So that's why it's really hard to find in the crypto space those coins that are not related to one another. It's hard to find the coin which goes up when at the same time other coins go down. It's really hard to find such coins. So that's why the ultimate diversification, from my practical experience, is achieved by having different strategies involved. So that can be, my rule is 50% in automation, 30% in smart trading. That's the just manual trading. Then you look at the chart, enter the market, set the stop loss, you set the take profit, and each day you monitor it and make adjustments. That's the smart trading, and this is where you can get the biggest return. And the 20% is just hodl. There are some coins that I just buy and I hodl them, and I do nothing about them. It's just that they are there in my portfolio, and that's okay for me. Because the thing about the hodl is that, let me just show you the chart here. The thing about hodl is that you can buy the coin. Let's say you were lucky enough to buy it and you were patient enough to hold it for a long time. And that's why you, where is that? Yeah, could have made decent returns. Let's say you bought it here and you hold it up to that point. So that's exactly 600% of the growth, right? That's what the hodl would bring you, right? I mean, it would bring you this return if you would sell it here, of course. But that's never like that, okay? Let's be realistic in that case. You buy the crypto, let's say here, you hold it, and at some point you are no longer patient enough to hold it because you are stressed, you feel like the market can fall, and you sell it too early, maybe here. So that's why instead of 600, your return is only 150%. That's why I only allocate around 20% to hodl strategy, and I promise to myself not to touch it for at least like half a year or even a year for some coins. Okay, that set the rule for yourself, not how long you will not touch the coin. Okay, and you must be confident that this allocation is perfect for you, that you can risk this 20% of your entire balance, because eventually some coins, they can drop to zero. And we actually had some cases, I think that was easy recently, easy to USD. Let's look at it. You see, boom, it's nothing, right? So imagine you bought easy at some point here, over here, and you hodled it up to that point. Wow, 300%, and you still keep hodling it because you believe the price will go even higher. Okay, but eventually what happened is that it was hacked or something. Yeah, the keys were hacked, and scammers and hackers, they actually got the access to the network, and actually they had this opportunity to manipulate, and that's why you see what what happened. It went just down. This is something that can happen. That means that your value of your investment would go to zero. That's something for you to always remember, because that still happens in crypto, because the market is still immature, and the risk here is insane for some coins, especially for unpopular coins, some unverified coins. That can be the case of the risk. It's especially those coins that were not audited by companies that actually scan the code on vulnerabilities, some things that the hackers can get access to. So really, be picky. I mean, select only those coins that you're confident that they were audited, that they have a decent team, that they have a transparent tokenomics, and that they have crystal clear incentives to hodl the coin, and that there is enough utility of the coin to justify its utility, and that the usage and the network capacity is having a long-term horizon perspective. That means that the value will appreciate. So that's something to look at then evaluating coins to consider for the investment. But in general, 20% hodl is the risk that you take to lose everything. In smart trade, your risk is under control. You have the stop loss, and that's why I allocate only 30%. Whereas 50% goes to automation, because in automation, once again, this is where I have the best risk control, because not only I have this feature as a result of the algorithm that it can achieve me the dollar cost averaging effect if the price falls. So that means it will give me the best entry price eventually as it buys. And also I have this stop loss, which is something that we have in smart trade as well. But here we have the stop loss. Here we have the dollar cost averaging effect, and everything is automated. And if the price goes higher, I can switch the trading up to make sure that my trading range will follow the rally. And if I am away from the laptop, I'm doing some other things in my life. Maybe I'm playing on the backyard with kids, or I'm traveling. I will be always sure that since I enabled the trading up, the bot will follow the rally, and it will keep making me money on a daily basis as I'm away doing something else. That's the thing. That's something that you will not have in smart trade mode, because in smart trade mode you have to manually adjust the orders that you set all the time. Here everything is automated, and that's why automation is really a big thing, honestly. Let me just show you my Combobot results real quick. So as the market was falling, I actually had this opportunity to... Okay, why I don't see it? Okay, let me just change the log. Let me just have another account. Just a second, guys. Okay, here we go. So here we have futures history. Yeah, so on this downfall, which like the pre-downfall, this pre-red day that happened yesterday, we had another series of downfalls. So I actually had doji short sell. This was my short sell bot. So I utilized the Combobot strategy, but short sell the market. So as the price of Doji was falling, this is the amount I made. And I also set the link, comp and BNB to trade on the downfall, so that this was my kind of hedge against the downfall. Because at the time of this downfall, even though my risk exposure, overall risk exposure, was around 15 or 10%, I was in the market at that time. In order to cover this 15% of the market exposure that I had, I decided to counter trade the market by actually short selling some coins. So these returns that I made during this period actually covered the loss that I incurred on my overall 15% market exposure. So that's why Bitsgap, guys, is the ultimate all-in-one platform where you can smart trade, where you can automate, and where you can actually hedge against the risk. Thanks to the Combobot that we just recently launched, which is not only for the rising market, but now you can actually make substantial returns even on the downfall by having the short trade mode. You see, short strategy enabled. So that's what I did for the Doji exactly. You see, only invested $150 to make 425 in just how long? Let me check. Yeah, you see exactly in what is that? In 20 hours, you see, 4 a.m. May, and I closed it here. So that's exactly 20 hours. I was in the market 20 hours, and by 20 hours, this is the amount we made, 300%. That's the cool thing. But the how to say, the thing to always keep in mind is that Combobot is really risky. That's the riskiest strategy that we have so far. That's because that's the futures market. So it means that here, for example, I risked $150, but it could be that I would lose even 300 on this trade. Let me actually show you some bad trades. I'm not that not that cool expert to show off these profit orders. Of course, I have losses. That's something that I also want to show you guys. Let's go from the March. Boom. Yeah, you see, these are my bad trades that I had. This is actually my whole story of futures trading with the Combobot on this account, I believe, or maybe that's the only account I have on Combobot. Yeah, so you see, so I had some first trades there. I actually lost twice more than I invested. You see, I invested 41, that's my margin in this trade, and I actually lost 84. Same in here, 30 investment, lost 60. Same here, 41. Well, actually, I just lost the entire balance here, so that's 44 in that case. So the reason for that is that in the Combobot, the way it works is completely different compared with the spot market bots that we have, the S bot and the classic bot. In case of the Combobot, let me show you. Let's have 10 grid levels. The thing about the Combobot is that you allocate the margin here in that case, because that's futures trading. Let's say I allocate 40. The way the algorithm distributes your initial margin is following. 50% is instant entry. So that means your instant market exposure is going to be 20 USDT as you launch this bot. Another 20 is here in the buy orders. These are actually DCA buy orders. But since this is a futures trading and we don't have this reduce only mode that we had in smart trading, in spot market. Here we can, in order to have something to sell, you need to short sell the market. So that's why to execute returns on these orders that would be initiated, we need to have counter trades, and these are short sell orders over here in that case. So that's another 20 USDT. And the thing about this bot is that we have another layer of DCA orders. So let's say the price falls and it executes all of these buy orders. And that means that your exposure rose from 20 plus 20. Now your risk exposure is 40. But we also enabled the second layer of DCA orders. Once this first layer is being executed by the market, you will see other DCA orders popping out over here. That's gonna be the second, and basically right now it's invisible, but in the algorithm it takes that into account. And when it triggers the first layer down to the last standing buy order in this first layer, this is the first layer. The second layer is what you will see coming next. It will set these new buy orders, and that's another 20 USDT. So all together, guys, it's 20 plus 20 plus it can be another 20. So that's already what? That's 60 per 60 USDT. But the maximum in any case can be 80 in this trade. Well, yeah, pretty much 80. So yeah, to make it simple, I mean, I went too far maybe. You risk 40, but always, no, actually you allocate 40, but you actually risk 80. Just multiply it by 2, okay? Just to put it simple. If you want to read why is that and how it works, just go to the Bitsgap blog. We have this fully explained. And in the help desk, we also have this guide that explains why it works like that and why your exposure can be twice more. But I just don't want to really go deep into the technical stuff. I just want to keep it simple. So to keep it simple, just know initial margin here 40, always multiply it by 2, and that's your maximum risk that you take. That's the maximum that you can lose, and you can see that here. You see, well, pretty much maximum 200. I lost 84 even though invested 41. Same here, invested 30 but lost 60. That's the thing. That's how it works, and that's for you to keep in mind. And I urge you to trade Combobot only if you understand the risks that are involved in futures trading and what is the leverage all about. And here is the leverage, by the way, and why the leverage, like the more leverage you put, the higher is the risk. So all these things you really need to understand before trading the Combobot, because once again, it can bring you insane returns, but the price for this insane return is to take a larger risk. That's the thing. So you can try trading it with smaller investments, and here you can afford trading with numbers like even $20, right? Let's check that out. Boom, boom. Come on, fix it. I don't want to look stupid in front of my guys. Just do what I say. Thanks God. Yeah, so I could launch it with $20 right now, and the maximum risk would be losing $40. But with this $20, I mean, if I'm right, let's say long, and I hold this bot for a long time, like up until here, I mean, this 20 can bring me $300, $200. That's the thing. And these are real cases here. You see 282% of the return. That's the one, the maximum that I had so far, 180, 164. So it's clearly up to you. See, I only hold it for how long, this one? Yeah, for 20 hours, that's the period. No, actually, sorry guys, actually I was wrong. That was 4 days. My bad. I actually had to scroll this further. Yeah, sorry for that. 4 days. In 4 days, that's the amount that we made here. 282, but still that's a pretty decent, impressive number still, right? It could be more maybe if I wouldn't close it. It depends. In the combo trading, when using the Combobot, I highly urge you to check it often, because here you really need to, even though the stop loss is trading, by the way, so it follows the, by the way, here the stop loss is trailing down, if that's the short bot, and it is trailing up if it is a long bot. And the trading range itself is also trailing automatically. If it's long, it goes up. If it's a short strategy, then it will move downwards together with the price. Initially, we wanted to call it a trend following bot because it follows the trend. It can be uptrend, it can be downtrend, but eventually it's the combo bot because it's the combination of the DCA and the grid strategy. Okay. Oh yeah, well, we discussed pretty much everything that I wanted. Let's see the questions that you have so far. I can see Xang, if I'm not mistaken, that's the right pronunciation. Xang says, I don't use Combobot. Well, I mean, yeah, it's up to you guys. I told you that's the riskiest strategy so far, and it really takes time to develop enough skills and confidence before you can afford your stress to trade the Combobot. I mean, it's really stressful to trade the Combobot if you're not experienced enough. But trading with this stop loss really makes you sleep well. And it applies to not only the futures trading, but for the classic trading on the spot market, the stop loss is a must. It lets you sleep well. Take profit as well. Let's see what questions you have so far. So when is the best time to close your position? Well, it depends. Again, it depends whether you feel like the market is about to change the direction. Then of course it makes sense to close the bot, because trading against the trend makes no sense. You will lose money. Another thing to consider when closing the position is whether or not you are satisfied with the return. So for example, for the doji I had here, I closed it manually because I was satisfied, and I felt like that's enough for this trade, because that's already 68% up to the balance initial that I have for this futures account. And yeah, that's the thing. I mean, whenever you see the market is now changing the direction, that's the time to close the bot. You only trade on the direction that you selected. Once it reverts, it makes no sense anymore. I can't set the Combobot with $20 and $40. Well, that actually depends on the coin. So for example, for Doji, let's actually check for 1 inch. If I can afford $20. Okay, so right now it says 39, 37. In order to reduce this requirement, you need to set fewer levels. So let's say 10 levels. Now I can launch this bot with 20 USDT. Okay, whatever, let's launch it with this amount. Start. So yeah, you see now we are in the market. 1 inch. Let's say it's 9. It should now increase. Come on, do this. What's happening with you? 9. Oh yeah, that's true, because I said it just takes time. Yeah, you see now 20, well, almost 20, because we also paid the fee, blah blah blah. So here we go. You see, with $20 I'm in the market on 1 inch, which is, by the way, not possible for Bitcoin on USDT. You see, let's say 20. And let's say I set 10, the minimum amount of grid levels. You see, still, that's not enough. 160 for this one is the minimum. That's because of the minimum trade size requirements per each pair that we have. So for BTC on USDT, it's this amount that it requires more per each level. Whereas on 1 inch, you saw it. It's 20 what was enough for 10 levels. So once again, answering to your question, just it depends on the cryptocurrency that you select. For some cases, for some cryptos, there is a minimum barrier. I mean, the barrier to enter is lower. Whereas for some cryptos like Bitcoin and I think like Aave, yeah, Aave is the one I also tried to launch with $20, but it was not possible because requirements were higher. So yeah, so it depends on the coin. Okay, with leverage 3x, 5x, let's try with 3x. Let's select maybe. Okay, let's select Doji. First, let's check with this 20. Yes, it's possible with 10x. What about 5x? Takes time. Come on. Yeah, you see, I can launch it with 5x. Let's say 3x. I mean, you see, still possible with 3x. No, actually you were right. You see, now it's not possible. It requires $33. But I mean, at least you now have a reduced leverage. But still you can set 20 with 5x. That's the thing. I see you're telling me that 10x leverage is higher risk. The risk here in futures trading is not really defined by the X leverage. It's more defined by the liquidation and the margin that you allocate. I mean, of course, the bigger is the leverage, the larger is the position value in general. And that means that if you allocate a small margin as a collateral, then your liquidation is going to be very tight, very closely to your entry price. So you can be quickly liquidated. It's all about the liquidation. The more margin you put, the bigger is the gap between the entry and the liquidation. That's the thing that only matters. And yes, leverage is just the mechanism to play with the margin requirements and all that stuff. Can I use any other exchange on the Combobot or only Binance? As of now, that's only Binance futures. That's enabled futures for the Combobot. And we are working on other exchanges as well. So stay tuned, guys. Stay tuned. Yeah, that's actually a pretty good suggestion from TechDon. Can we have the bots updated such that we can have option to set an entry price or choose market entry when we fire up the bot? Well, this would actually be cool because I also thought of that for example, let's say I don't want to enter the market right now. For example, let's say I feel like the price will fall to that point and this is where I would like to enter the market. So it would be cool to preset the bot on this price level. Yeah, agreed. This would be a cool feature. But we are actually working on that, guys. I mean, it's not that easy to implement everything at one day. It's just an ongoing process development, and that's why always stay tuned, always look for the future webcasts, watch the YouTube, subscribe to channels, participate in communications, leave your feedback in the comment section below. It's just that the more you speak, the more you comment, the more you participate as a community, there are more chances that we will quicker implement those developments and those tools that you guys really need. So yeah, speak up. I mean, don't forget it. It's the only thing to achieve what you need is just to tell what you need in how to say, in a justified manner. So for example, this suggestion to have to have a postponed launch is a cool feature, by the way, and we are actually working on that. So yeah, really stay tuned. Yes, Trevory Pop, we actually covered the classic bot. Yeah. So I mean, of course, I covered it in other previous webcasts, and you can find it on the YouTube. We had some recordings, so feel free to watch them whenever you can afford, at your earliest convenience. You can always find something new, because in each webcast I'm trying to tell something new, to show you something new as much as possible. I mean, we are limited to the amount of tools that we have here, so I mean, that's why I really need to be very creative, coming up with new things to show you. But yes, that's something that I ensure to make. Each webcast you will find something new. So yeah, by the way, that's it for today. It's been a pleasure, guys, and I hope I could answer to the most of your questions. And thanks to the Yegor, who is supporting me in the chat. Thanks a lot. Big shout out to Yegor. If you have some questions unanswered, then please feel free to ask them here, for example. You know this one. It's the button that pops out every time you log in to Bitsgap. You can ask your question there. You can join the Telegram community, or to broaden your mind, to learn more about some useful tips and tricks, go to blog, and here we have strategies. Like, those articles are very useful, and I wrote them, so you can actually find ready-made strategies, everything explained. Use them, just grab it. I mean, it's there for you guys. It's not about just webcast, it's also about your personal growth. I mean, play with the demo mode, which is a risk-free trading simulator. Here you have virtual money to trade with, to play with, experiment, and you see, oh, by the way, look at this experiment, 70% in 21 days. I mean, it just was a sample trade, but look at that. Holy crap, that's cool. It's really cool. But yeah, I mean, it's not real money, but yeah, anyway, play with it. Play with this virtual money to find your ultimate strategy. I mean, figure out which grid step is the best for you. Yeah, for me, by the way, guys, for the rest of you who did not left yet, my trading range for the spot market, the best one, is from 0.7% to 1.3%. So whenever I set the trading range, I always make sure that my grid step is around this area and range, yeah, because this brings me around 30% per month. That's my high watermark for the bot. If it's 30%, that's cool. If it's more than 30%, even better. And I learned from my practical orientation that this is the trading range that works for me the best when trading the classic bot and the spot. But most of the time I'm trading the S-bot market. Sorry, the S-bot strategy. Yeah. So I mean, it's it's here for you in the blog, on the YouTube, in the Telegram. People share their ideas, their trade configurations. If you feel like your trade configuration is perfect, click share. Yeah, and you can actually share the exact setup that you use. And not only that, you actually share the referral link. And if the guy who now subscribes by that link, you will get the reward. And by the way, well, I mean, it's everything explained here. I mean, it's a win-win. You can share your strategies, and you can also bring your guys on board to trade with you together. You can actually select your own team on Bitsgap, and then eventually all together we can participate in various tournaments that we have on Binance, on okex. Let me check when was the last time we had the competition. yeah, you see, it was the spring tournament when we participated, and I remember it was around 700 people in total from Bitsgap. So yeah, trade, share, experiment, develop, and once you are confident in your trading, you can now trade with the real money. Thanks to the demo mode where you can experiment, develop, that's your basically sandbox before you risk your real money. So stay tuned, really appreciate your time. I never take your time for granted. And even if only 10 people would come, I would still host the webcast, which was, by the way, the case of the previous webcast when we had some slight technical issues and many left. Only around 40 people, I guess, were online. I still hosted this webcast. So yeah, stay tuned. Cheers.